I mean, should be fine. It'll be fine. Don't know how
Okay, folks. I don't know why the lighting in this room is always set to expensive restaurant level, which is you can't see what you're eating, you can't see what you're doing. So that's the first thing I'm going to try to do when I get in is I'm going to turn the lights on. It's tough enough staying asleep when the lights are on. Yeah. It's so much, perhaps a little easier to stay awake when the lights are on. So I am writing my DeepSeek post. The story is starting, right? So I'm going to try out what we have so far, and maybe you can help me. So until last Friday, there was an AI story being sold, right? The AI story was a story of, if you think in pieces, of an AI architecture that would require what? Until last Friday, what were we told? Really expensive chips that NVIDIA had a significant advantage over everybody else, and they were all scrambling. But you needed the chips, and you also needed huge amounts of data because the argument is AI needs to go through the data. So it's a supercomputing skills plus data, which essentially already creates a high entry cost for the business, right? And then what would the companies that invest in the architecture do? They'd produce AI products and services that we would all want so much that we would pay premium prices for. Why premium prices? Because only the people who went through the entry barrier would get there. The market buy into it. I mean, think about the trillions in market cap that have been added. It's not just the companies in the architecture space, right? NVIDIA was obviously the most logical one, but it also was the power companies, the gas. I mean, there's a whole ecosystem that built off these data centers. And on the product and service side, there was more skepticism. Why? Because you can talk about AI products and service. We all, I mean, I don't know whatever program you use, notice there's a little AI button in them. I have no idea. This is Zoom. There's an AI button on Zoom. I don't know what it does. I'm terrified to find out. But every product and service adds. But let me ask you a question. How many of you are paying a premium for an AI addendum to your product? You are? Okay, that's good. There's a start here. But that's the hope, right? The products and services that a LinkedIn member will pay a premium to buy LinkedIn AI. And that Microsoft will be able to charge a premium price because they and only they spend. That was until last Friday. I mean, I know there are a lot of distractions with the DeepSeek story. First is that came out of China, and already you get a political discussion of what does this mean. There was also a distraction that cost only 6.3 million, which is an absolute lie. We know that that's it might have been for a piece of the puzzle. My guess it cost hundreds of millions. We counted the time, and maybe even a few NVIDIA AI chips were involved somewhere in the game to get it off. But it's an incredible accomplishment. Even if it cost them $1 billion, that's less than what is Meta spending on AI architecture this year? I mean, 65 billion is the word. And Microsoft, of course, 80 billion. I mean, $1 billion. But what the bigger story here is not whether DeepSeek is better than ChatGPT. It might or might not. It's that it's broken the story open. By doing what? By saying a lot of these AI products and services that will emerge don't require those expensive chips, don't require data. Now, early on, one of my problems with the AI story is, let's say I build an AI model to do fair value accounting. It's a rule-based system entirely. I don't need to dig through how every accountant in history has ever done accounting. I couldn't care less. In fact, it might be a distraction. You give me the rules. I don't need super chips. It's not rocket science. Add, subtract, multiply, divide. I'm not running simulations. Clearly, for that business, you don't need that investment. It's like the emperor's new clothes, right? Why didn't I think about this until last Friday? Because we saw the people making the pronouncements. They came with degrees, with pedigree, and they said these tech titans and the VCs must know what they're talking about. And DeepSeek basically said that might not be true. Yeah.
Would you put something like DeepSeek and something like OpenAI in the same market classification though? Because
ultimately they're not markets. The market is for products and services. Neither OpenAI nor DeepSeek is a product by itself. By itself, if this were entire market, it's a tiny market, right? So if you're saying how much would people pay for ChatGPT as the end game? If this were end market, we've been paying way too much for AI. The truth is the AI product and services are much, they don't specify, but their claim is it can do pretty much everything, right? It can decide what your next product should be. It can decide what geography to go into. So that's why I think this whole discussion of DeepSeek better than ChatGPT, there'll be like 12 articles you read over the next week that try this out and say, oh, ChatGPT, my wife uses ChatGPT when she uses the most, when she has to send an email. She teaches 5th grade. So you got to send an email to the parent of a kid and she's really pissed off. She writes off the email in a pissed off mood, and then she asks ChatGPT to rewrite the email in more friendly terms. It does a really good job, right? Because it's read every email that's ever been sent. And that's why DeepSeek, actually, the first run of it shows that it's better for scientific, mechanical, rule-based stuff than for writing a better email to parents. So I think that that fight might play out, but ultimately this is about what does it mean. So let's go down the list. What does it mean for the AI architecture business post DeepSeek? Will less money be spent on architecture, more money be spent on architecture? It has to be less money, right? You don't need the big thing, but it doesn't mean that you don't invest in NVIDIA chips. Not every AI product and service can do what the DeepSeek crowd and saying, I don't have to look. So there's going to be a segment of that AI product and service market where the old story still holds. The question now is that 40% of the market, you're saying, I don't know, this is the time to make your best estimate. You say, I'll wait for it to play out. You won't be buying an AI stock till 2035 then, by which time it's too late. What does it mean for the ultimate product and services that come out of AI? Will what DeepSeek do increase the number of products and services we'll have access to? Absolutely. But it'll be commoditized. A big chunk of it is going to be commoditized because entry is going to be so low. So from the consumer's perspective, this is really good news. You're going to see a lot more AI stuff coming at you, and much of it will be either free or really low cost. So it's basically made the market both bigger and more commoditized. And if you're valuing a company, that's got to play out somewhere in the middle. Where does the commoditized play? Lower margin business, big business. I think that it's going to play out, and I'm going to take my first shot at it. And don't wait for my post. Start thinking about this is what valuation is, thinking through stories as they evolve. So what I'd like to do today is I'll actually try to bring in NVIDIA next week. So this week, I want you to value the S&P 500. I put it out there. I noticed a few of you. It's interesting because my valuation of the S&P, does anybody remember what my valuation came out with? Overvalued by 11.78%. You know, the median overvalue, there are 55 people I've checked in the Google shared spreadsheet. The median is around 11.75%. This is looking suspiciously like you're tracking me. But remember what I said, early in this process, that's going to happen. Later as we go through, you're going to disagree, and that's going to be healthy, right? So make it your story. This is my valuation is not the valuation, it's my valuation. Make it yours. So today I want to start with the topic, and this is something you're going to see with every class. I'm going to start the class with the start of the class quiz. You know what I'm going to quiz you on? Not what we did last session, but what we're going to do in the next set. You see, this is stupid. That's asked backwards, right? What I want to do with each of these sessions at the start of the class is in the test, I'm going to show you the test, and I'm going to ask you to intuitively pick what you think the answer is. And 95% of the time, you know what you're going to find once we go through all the gymnastics is your intuition was right. Trust your gut, and hopefully this process will start to help you trust your gut. So one of the things we're going to talk about today is bias. What I mean by bias is when you sit down to value a company, the rest of you comes along for the ride. What's the rest of you? Your brain, your soul, your history. So let's think about first where bias comes from. Bias essentially comes from all over the place. The first is what I call the power of the subconscious. Okay. When you're valuing a company, right this week when you value NVIDIA, my guess is your valuations are going to get pushed down. Why? Because you saw what happened in the market, you're a little nervous. It's herd behavior, you know, you think that's not rational, it's supremely rational. I feel sorry for the caveman who was a contrarian. He wouldn't have made it very long, right? The entire tribe is running towards you, you run in the opposite direction, you're going to get stomped by a mammoth or something along the way. The second is what I call hindsight bias. What is that? Well, you look back and say, I knew DeepSeek was coming. There are going to be an incredibly large number of people on CNBC claiming they saw the whole thing. It's a complete lie, but it's human nature. I saw that coming. So some of this you don't control. It's kind of bubbling in the subconscious. It's going to find your way into your valuation. The second is the power of suggestion. Now, I once talked to a managing director of an investment bank, and he was worried about the fact that valuations were poor quality. And I said, tell me what you do. He was in the IPO section. He said, look, we have an IPO to value. I give my analysts the prospectus and I ask them to value the company. And I do throw a number at the end. I say, I think this company is worth about 8 times EBITDA. I think that's where. And he says, they keep coming back with an answer that confirms my initial number. I said, what did you think would happen? You throw a number out there. In fact, I remember teaching a version of this class, I think about 15 years ago. I taught 2 MBA sections. So completely random which person ended up in which section. And at that time, there was a middle of the semester project I used to include, which I don't anymore. Why? Because your second years, some of you prematurely graduate, so it's kind of tough to get you to do stuff middle of the semester. Yeah. But it's an IPO. Same company for both groups. I gave them the prospectus. With one group, I gave the prospectus, I value the company, try your best. The second group, I said, value the company, try your best. And there are rumors floating around that the offering price might be about $35. Valuations come back. The first group, the value centered around $21. Second group, the valuation is, when I value IPOs, one of the things I try to avoid looking at is that offering price number starts to show up in the news, right? The Wall Street Journal, it's rumored that. You're saying I can ignore it. You might be. I don't think I can. And third, and this is the most powerful force behind bias, is most of you will end up doing valuation not for yourselves and your investment decisions, but for a living. And I'm going to say something that appraisers find harsh, but the truth shall set you free. You tell me who pays you and how much you get paid. I'll tell you which direction the bias is and how much the bias is. I'll give you a story later on, but I want you to kind of think about bias because I'm now going to put you in a position of somebody valuing a company, and what I want you to tell me is which direction the bias is. So let's say you're an entrepreneur. You have a business. I'm a venture capitalist. So let's play Shark Tank, right? I'm not Kevin O'Leary. You can pick any other shark you want. So you describe your business and you want me to invest. Tell me how the VC capital raising structure works. You come and raise money from me. What do I get in return? Not just equity, a piece of your business, right? So when you come in for this negotiation, you're valuing your own business for this negotiation. Do you want to come in with a really high number or a really low number? Oh, so where is it going to show up? You're going to use big growth rates, and if you use the VC game, a high multiple at the end, a target pricing. Basically, your bias is upward. On the other side of the table, as a VC, my bias cuts in exactly the other direction. Much of the debate in venture capital is not about value. It's about, hey, use a target multiple of 10. I'll use one of 4. You discount that back by 30%. I'll use 50%. What VCs call discount rates is a complete lie. It's a negotiating tool that 50% is, we know it's fiction, but they can use it to make your high number into a low number. Bias. Second, let's say you're valuing your business. You've now built a business, but you've gone through a very tough personal crisis. You're in the middle of a divorce, and your soon-to-be ex-spouse, who you don't like that much anymore, is demanding half the value of your business. So you come to me as an appraiser to value business. Do you want a high number or a low number? Preferably 0, right? Because half of 0 is 0. So you throw yourself at the mercy of the court, say, look, I am a terrible business person. I'm a horrible manager. I'll run my business into the ground. It's worth 0. Give my ex-spouse half of 0. Let's say you're an appraiser for an owner who is getting a value for the company because the tax guy wants to take 30% of that number. I think there might be a wee bit of bias in what you do. Yeah? You want the number to be as low as possible. If you look at private company appraisal, 80% of valuations of a divorce court, tax court, where the objective is to get the number as low as possible, you know how this shows up? There's a heck of a lot of discounting that happens in private company valuation. They'll value a company and take off 25% for liquidity. Why? Make the number lower. They can't say that, but no, it's for liquidity. Then they'll take another 30% off. You're a private company. Now you're getting desperate. You can't even name the discount. I'm surprised after all this discounting, you end up with a number greater than 0, but I can see the bias playing out. And if you're an appraiser for the IRS, you have the exact opposite objective. The only thing is the IRS is usually cheap. It doesn't pay its expert witnesses that much. So when this gets into a contest, and they tend to lose, but it's still two sides pulling in different directions. And let's say you are an equity research analyst. For those of you not familiar with how equity research is structured, you have buy-side equity research analysts. Who do they work for? Fidelity, State Street. They work for mutual fund or fund management companies. Their job is to value companies, so their portfolio managers internally can pick stocks and decide what to invest in. You'll never see, or you'll seldom see, a buy-side equity research analyst quoted in the Wall Street Journal because that's not their job. So when you see an equity research analyst mentioned in the journal, it's almost always a sell-side equity research analyst. So you're a sell-side equity research analyst. Congratulations. You're given a sector, usually 15 or 20 companies. You're told these are the companies you're going to track for the rest of your life. I would leave the job right away, but people say that's okay, I'm okay with that. And what's your job then? To track these companies and to put buy recommendations and sell recommendations. People think, okay, equity research analysts value companies, they might value them, they might be priced them, but my question is about bias, right? If you come up with a high number for your company, whether it's the value or price, it's a buy. If you come up with a low number, it's going to be a sell. You think there might be bias in this process? Why?
Because they want to move the client. Basically, it's like a.
So you're saying a buy is much better for you than a sell, right? So whatever because you have 3 different constituencies here, right? You have your managing director and the investment bank who might have other business to do with the company. I'll let you decide how that plays out when you put a sell recommendation on a company. You have investors presumably are waiting with bated breath for, is he putting a buy or a sell? Okay. And then there's the company itself, the 15 or 20 companies. See, why would I care about them? Because you're going to live with them for the rest of your life, right? If you're an equity researcher, let's cut to the chase. You're using the same public information that I am. You have no differential advantage. You have an Excel spreadsheet? I have one too. Use Python? I can get Python, get somebody to run. I've never used Python in my valuation, but I can do that. You do have a small edge, which is what? You talk to the management. Don't be careful about going beyond that. You just talk. Because in the US, the SEC is very clear about this notion of private versus public. But let's face it, you're waiting for these morsels of information that are not quite information, but they give you a little edge. That's your edge. So you put a sell recommendation, what happens? You pick up the phone, you call the company, and they all hang up on you. You know, buy recommendations outnumber sell recommendations 10 to 1. It used to be 25 to 1 in the 1990s. It's now 10 to 1. You pick any company, even the worst company, buys will outnumber sells. Because there is bias in this process. You're saying, I hate sell side, you quit sell side, you go to work for Fidelity. And I'm a portfolio manager at Fidelity. Remember, you work for me. And I tell you where I am. I own 10 million shares of NVIDIA, and I'm deeply, troubled by this news that's come out about DeepSeek. And I ask you to value NVIDIA. You're saying, this is good. I can do an objective valuation. Remember, you want to also see, when I give this news to my portfolio manager, will he be happy or will he be upset, right? You see, that's nothing to do with value. It's got everything to do with how he's going to treat you afterwards, or she's going to treat you. What is the answer analysis I would like you to come back that would make me happier? What makes my life easier as a portfolio manager? I don't have to sell it, because the minute I sell it, that's confirmation. I'm going to let's say I bought it at the start of this year, I'm selling it, I'm writing off on $15, $16 per share. So I'd like you to tell me that it's okay, you can hold on. Conversely, if I am at a hedge fund, I've sold short an NVIDIA, and I say, what do you think about my decision? I want you to say, amazing. I don't know whether you've ever seen this movie, A Few Good Men. It's a Jack Nicholson movie. I'd like you to watch it, especially towards the end of the movie. There's this court scene where Jack Nicholson is in court, and he's being questioned by, I don't know, Tom Cruise, right? Whoever the lawyer was in there. And he is, basically there are all these bad things that Jack Nicholson has done that he's covered up. And, the lawyer says, Mr. I don't know, forget the name of it, General so-and-so, could you please tell us the truth? And remember what Jack says? You cannot handle the truth. And that, in fact, is something we have to remember. People claim they want to know the true value for the company, but I need to have that Jack Nicholson means that you cannot handle the truth, right? People don't want to hear the truth. They want to have confirmation that whatever they're thinking is okay. And you can lie about it, dance around it, but it is a source of bias. One final question about bias. Let's say you are a banker and you're in the M&A group. So tell me again how this process works. I'm an acquiring company. You're a banker. I come to you with a target company that I want to do a merger with and ask you, is this a good deal? Dumbest question ever. Because asking a banker whether a deal makes sense is like asking a plastic surgeon whether there's something wrong with your face, right? What is he going to say? This is a terrible deal? In which case, what does he get paid, even if that's the truth? Nothing. You get 100 million if the deal goes through. You think, again, there might be a wee bit of bias. This is the most biased process that I can think of. M&A is where valuation first principles go to die. Because your end game is to justify the unjustifiable. The value of a target company is always $10 more than what you chose to pay for it. But for 2 weeks, we go through spreadsheets and changing numbers and going to the managing director and say, that number looks too low. Why don't you try this? Why don't we just cut to the chase? Skip that 2 weeks and just say, value the target company. It'll be much more honest, much cleaner. And the target company has the same incentive. It wants to make that there is nobody in that room who does not want the deal to go through, right? Acquiring company share managers, target company managers, acquiring company bankers. You know who's missing in the room, right? Whose money is being thrown around? So it's the shareholders. You think, what's the board of directors doing? What boards of directors do all over the world? Sleep on the job. When was the last time a board actually stepped in and said, you guys are paying too much, don't do the deal? It's an exception. It sometimes happens. When it happens, you say, really, this can happen? So when you have mergers, again, bias feeds through. And I'll let you think about what happens in a hostile takeover, because one of the trickiest things in a hostile takeover is the two sides have different end games, right? You're the banker for an acquiring company. You want to convince your shareholders that this is a good deal by showing them what? That they're paying less than something is worth. Once that's out, you give an ammunition to the target company bankers because they go to their shareholders and say, look, they said they're paying less than it's worth. That's not a good deal for you. How do you navigate this? You invent words like synergy that allows the magic to kind of flow through and say, I can be right and not be lying. Bias is endemic to the M&A process. So it might sound like something we should be talking about more substantial things, but the truth is, often when valuations go bad, it's because of one or more of those biases. So before I started today's slides of the intro to valuation, I want to say a few things about the project that I mentioned last class. I said form a group. I don't know whether I gave you parameters and group numbers. It can be anywhere from 4 to 8. Okay? For those of you who are in my corporate finance class, the good news is this group requires far less group interaction than this. You pick a company, you pretty much sail through. There might be 1 or 2 meetings towards the end to make sure that you all got done. That's really what you're checking. Why? Because as second-year MBAs, which is what many of you are, you're a little sick of each other, I would think, in terms of group work. I don't want to hang out with those people. I'm getting ready to get out of here. I built that into the group dynamics, right? So you're going to pick a group and every one of you can pick whatever company you want. Unlike the corporate finance project where you have to pick a common theme, there's no common theme. You can pick whatever company rings you a bell. So if you are obsessed with the Super Bowl and you can't let go, value DraftKings. You're saying, why can't I value the Kansas City Chiefs? Well, if they give you access to the financials, by all means value the Kansas City Chiefs, and then you can value the Taylor Swift premium built into the Kansas City Chiefs, right? That'll be a fascinating exercise. You pick any company. Can you pick a private company? Yes. Again, if you have access to the financials. If you have a family business you'd like valued, pick that. So each of you picks a company. If you have 8 people in your group, you'll have 8 companies. Okay? There is one constraint I will add, and I'll come back and talk about what that March 29th is. Here's the constraint I'm going to add. At least one of the companies in your group has to be a money-losing company with operating losses in the most recent 12 months. Okay? At least one of your companies has to have high growth potential with growth defined in revenues, not earnings, because earnings growth can sometimes be just because of accounting fixes, cost cutting. This has to be your business is growing. At least one of your companies has to be a non-US company, and I would like you, if you can, to value that company in the local currency. So don't pick a Brazilian company and value the ADR in dollars because I want you to deal with a valuation in reais or pesos or rupiah. Okay? And at least one of your companies is a service company. I should take that requirement out because pretty much every company is now a service company. Why do I put this constraint? Because if all you do is pick nice, mature companies with a lot of history, you really don't need this class. I want you to wrestle with the pain of difficult to value companies. Of course, you could evade the system, and here's what you can do. Form a group of 4, pick nice, mature companies that all make money, then open your group to a 5th person and tell them, you can join our group if you pick a money-losing, high-growth foreign company. There are a few of those, right? This way you pile it all on that person, but you got to decide what you came into the class for. And if you want an easy ride, pick Procter & Gamble. It'll be easy to value. Boring as heck, but easy to value. If you want a challenge, pick a company that's young, that's money-losing, because that's where you will essentially get to deal with the big questions in valuation. Pick a company in the AI space right now, right? Everybody is saying, I don't know what's going to happen. This is exactly the time to do it. Okay? So any questions on the group project? Yes, go ahead, Julian.
Sorry, this is obvious, but does it have to be public? Can it be private? Like, should it be public because there's just clear information? Not necessarily.
All I need is a value, right? So the difference of the public versus private, what's the one thing you're going to have with a public company that actually makes your life a little easier?
Accounting.
It's not the financials. Financials look very similar. It's the fact that when you're done, you can at least tell whether you're completely off the reservation, right? By doing what? By comparing the market price. You come up with a value per share of 1,500 and the market price is $1.50. My guess is you got a unit wrong somewhere, right? And it's good to know. Whereas in the private company, you're saying, I don't know. So it is actually sometimes interesting to think about how much you rely on the market price while you complain about the market. So I have no problem with you picking a private company, an IPO, privately, a family group company. So as long as you can access the financials. So what I'm going to do for the rest of this session, spilling over to the next one, is talk about the different ways you can put a number on a company. When I first started teaching valuation, I made the mistake of assuming that everybody else was as interested in valuation as I was. Huge mistake, because it turns out that most people don't believe in valuation. Even most people who do valuation for a living, you say, but they do it every day. They do it because it's their job. They do it to cover their rear ends. But if you caught them in an honest moment and asked, why is NVIDIA trading at $125 per share? You know what the answer is? Because that's what the market thinks it's worth. If that's what I felt about valuation, I couldn't teach this class. So I'm going to tell you why I do valuation. I do valuation to fight the lemming in me. Heard of lemmings? Lemmings became famous or infamous in the 1950s. When either National Geographic or Disney, the parentage is a little unclear, created this documentary / movie where they filmed this most amazing sight. Thousands of big, ugly, rat-like creatures. The way you could tell is if it were Disney, the rat-like creatures would probably have been cute looking because nothing in a Disney movie can be not cute. Gathered together on a cliff, ran right off the cliff into the ocean and committed collective suicide. And ever since, one of the big questions is, why did they do it? Were they off their medication? What is it that drives them? I don't know the answer, but you can do some virtual imagery. You can see why the first lemming did it, right? He was going too fast. He couldn't stop, off the cliff, into the ocean. Incidentally, these guys can't swim, so that seals the deal, dead. Second guy, too close to the first guy, also off that same cliff into the ocean, also dead. But I'd like you to put yourself in the shoes of the very last lemming. I know lemmings don't wear shoes, but kind of hang in there with the analogy anyway. You're the very last lemming in your group. You're running towards a cliff. You've seen your entire tribe disappear off that cliff, right? I would think you'd have second thoughts about what you were just planning to do. Your left brain, right brain, whatever part of you is rational, saying, stop, stop. And then you hear this voice in the back of your head. You know what it's saying? They must know something that you don't. Remember those 7 words in investing in valuation. I promise you will hear those words. You know when you hear those words? Is when you value NVIDIA and you come up with $160 per share and your rational says, go buy the stock, and you're looking at everybody else selling. You say, they must know something that I don't. I heard it last September. I valued NVIDIA at $89 per share, and that was with a really big AI story with all the stuff that I told you. And this was after the earnings report, the stock had dropped to 108. And I said, everybody's talking about bargain basement. This is what you're going to get. And my first reaction was, it looks overvalued still. But I heard that voice. They must know something that you don't. It speaks in a monotone. Don't ask me why. And when you hear it, magical things will tend to happen to your valuation. Your growth rate will start to go up. Your cash flows will start to get more positive. Your discount rate will get lower. 89 will become 95, 97. You will notice this phenomenon play out when you value a company. The market price will act like a magnet. And you will move closer and closer to it because that's the most comfortable place to be. They must know something that you don't. I divide the whole world of investors into 3 groups of lemmings. The first group I call proud lemmings. And I'm a lemming, and I'm proud to be a lemming. They call themselves momentum investors, but it's pretty much the same thing, right? What do momentum investors do? They look for a crowd, they join in. You're buying, I'm buying. You're selling, I'm selling. Why are you buying? I really don't care. I can't pull off being a proud lemming. It seems so mindless. But clearly, some people are drawn to it. The second group I call Yogi Bear lemmings. You heard of the legend of Yogi Bear? Lived in Yellowstone Park, was smarter than the average bear. Yogi Bear lemmings think they're smarter than the average lemming. You know what they want to do? They want to run with the rest of the lemmings to the very edge of the cliff, and the last moment, veer away. Admit it, you're tempted. You're saying, there's so many stupid people out there. I have an MBA from Stern. I've taken a valuation class. I'm smarter than the average lemming. I know where the cliff is coming. Do you? I don't. I would love to tell you that I saw DeepSeek coming last weekend. I'd be lying. I would love to tell you I saw COVID take down the market, but I would. After the cliff comes, always people look back and say, I knew that was coming, but how come you never mentioned it? I can't be a proud lemming. I'm not smarter than the average lemming. I can't tell where the cliff is. So if you ask me to describe myself, that's me right there. A lemming with a life vest. That's all I aspire to be. I mean, you're a human being. Are you going to get caught up in the mood of the moment? Absolutely. How the heck do you keep it out of the? So on Monday, if you own NVIDIA, don't tell me that you didn't feel fear. Don't tell me that you didn't feel that urge to sell, because you'd be lying. You know what valuation does for me? It slows the process down. So I do own a piece of the NVIDIA that I bought in 2018. I saw the pain that the weekend inflicted on my portfolio. I felt this desire to join the crowd. So I said, look, let me try revaluing NVIDIA. That's going to show up on next Tuesday as an evaluation of the week. But I don't do it for you. I do it for myself. I do it to slow the process down, to allow my rational side to mount an argument. Maybe I'll join the rest of the crowd after I've done it. But valuation is about slowing the process down. So you're not just looking at what other people are doing and trying to do the same thing. So with that in place, let's get rid of some misconceptions about valuation. The first one I already talked about, bias. This notion that you're some kind of scientist valuing companies gets fed into because we sit in front of computers, we have all these numbers, we feed them in. After a while, we say, I am being objective. I just work with the numbers. That's an absolute lie. Every valuation is biased for lots of different reasons. I'll give you a personal example. I've valued Microsoft every year since 1986, the year of their IPO. For the first 28 years of their existence, I'll talk about what happened in year 28. Every time I valued Microsoft, I found it to be overvalued. $2 overvalued, $4. It's strange, right? One of the great success stories of the 20th century in terms of equity markets. I wouldn't have touched it one step away. By 1999, Microsoft was the largest market cap company in the US, and I've said overvalued every step of the way. I could give you access to every single Microsoft valuation I've done. The first two were in Lotus because Excel hadn't showed up. So you'll have to figure out a way to open a Lotus spreadsheet. And you could dig through the spreadsheets looking for clues, but you'd be looking in the wrong place. You really want to know why I found Microsoft to be overvalued? I would say go to the elevators, but these won't take you to the right floor. Go down one floor, hit the elevator button. I want to be specific. Get up to the 9th floor and find your way to my office. It's tough to find. It's like warrants of rooms, but eventually you'll get there. The door's open. Walk in. Don't take any of the stuff. Just look around. And here's what you're going to see. You're going to see my MacBook Pro on a table. And right next to it, you will see my iPad. Why? Because I like to watch movies while I work on my MacBook Pro. I think I brought my my AirPods today. You should see the little thing charging. I just capitulated and I have an Apple Watch. Took me until 10 to get to it. Apple 10, no. I finally capitulated because I'm hoping that I don't need to bring my phone down to log in, because every time I come in without my phone, I'm stuck. It's like a dead terminal. Now I'll see if that works. It hasn't worked so far, so I might have to return the watch. But if you stay in my office and look up towards the top shelf, on the very top shelf, you'll see a Mac 128K. That was my very first Mac, 1982. It's a Mac that came without a hard drive. It came with a floppy disk, which you had to flip out. And it actually works. I've been an Apple user since 1981. And to me, Microsoft has always been the Darth Vader of technology. For those of you Star Wars fans, let me be very specific about which Darth Vader I'm talking about. I'm not talking episodes 1, 2, 3 Darth Vader, the Anakin Skywalker cute kid. I'm talking 4, 5, 6. Guy dressed in black, wears a mask, never takes a shower. I don't know what, and I've always wondered, does Darth Vader take a shower? It keeps me awake at night. But I have lots of bad thoughts about Bill Gates, and this is pre-vaccine, nothing to do with vaccines. They've come bubbling up to the surface. So when I sat down to value Microsoft, high growth or low growth, and I got to pick, I said, who buy this rotten product? Low growth. High risk or low risk, one virus away from going up, high risk. And by the time I made my choices, always overvalued. You know what I learned? I hate the company too much to have a value. So what happened after 28 years? I started feeling sorry for Microsoft. You remember in 2013, Apple had left Microsoft in the dust, right? It was in terms of corporate life cycle, an old company with two big cash cows, Windows and Office, kind of trudging its way towards death. It's tough to hate a company and you feel sorry for it. So you know what I did? I ended up buying Microsoft. Some of your best investment decisions come from the worst motives. I didn't buy Microsoft because I saw the cloud business taking off, or even because I thought Satya Nadella was a great CEO. I bought it because I felt sorry for the company. But I've also given you a clue of another company I've had really difficult time valuing over the last 35 years, right? Which is Apple. I love the company too much. If you go to my blog, I valued Apple every year. And if you look at my first valuation of Apple, I think in 2010, I spent half the post telling people, don't trust me. That's all I can do. I can't say I'm going to set it to the side. That would be a lie to say I'm going to be objective. When you sit down, each of you is going to pick a company, whether you like it or not for the project, right? And it's not going to be from a blank slate. It's going to be because, have you picked a company yet? Right? Anybody picked a company? Okay, who do you pick out?
On shoe company.
On. So On, are you familiar with On shoes? I mean, I've gone on the site, I've looked at the shoes, and then it's $180. I'm not paying, but I'm old, so. But it's a company that's taken off, that essentially has broken into a business where companies like Nike and Adidas have been incredibly successful. So why do you pick On? And what's the stuff you've heard about On?
The millennials love
That
it.
people love it. So already you're walking in. My guess is already going. So if you find your company to be overvalued, you might take a look and say, everybody else loves the company. Why am I missing? And what's the stock price there? And from what? So what has it done in terms of change over there? So all those things will, whether you like it or not, will affect when you value the company, what do you think about the company, right? In fact, what are you told to do when you first start valuing is go find out as much as you can, read as much as you can about the company, talk to the management of the company. Worst advice ever. In my 40 years of valuation, I've never once talked to the management of a company. Two reasons. One is, what the heck are you going to learn from them? They're PR people. They're going to tell you a nice story. And second, they're going to put handcuffs on you, right? We gave you the information. We'd like to review your valuation. No, I want to reserve the right to say terrible things about management. And I want to give up that right because the CEO says, I'll tell you something secret about the company. And if you play golf with the CEO of the company every weekend, I'm not interested in your recommendation, buy or sell. I have a feeling that your golf game will have much more to do with what you put as a recommendation than what you see about the company. And if you get paid to do valuation, you saw that play out in that start of the class quiz, then God help you, because bias will kind of, I mean, he who pays the piper calls the tune. And if you get paid, it's not because you're a bad person. I'm not accusing you of being dishonest, but you will find ways to move your valuation towards what the paying client wants. And you will convince yourself you're doing it for all the right reasons, right? And we'll talk about all the ways you can do it, but bias plays out. So I'll tell you a story to show how deep bias is and how it can embed into valuation. About 30 years ago, a company called Lynn Cable. Obviously, it's a broadcasting company, a cable company. And AT&T had this option to buy 49% of Lynn Cable at an appraised value. So that's where the option was written. The time for the option to be exercised comes about. AT&T goes out and hires Morgan Stanley. So you guys are going to be Morgan Stanley. You work for AT&T, and what's your job? To assess the value of the 49%, so AT&T can pay for that 49%. So you work for the buyer. Lynn Cable goes out and hires Lehman Brothers. I'm sorry to do this to you, but think of yourselves as pre-bankrupt Lehman Brothers. And your job is to assess the value of the same 49% so I can sell it. Same financial, same company. Two banks go to work. Come back with two valuations. One is $105 per share. The other is $155 per share. I want you to guess which side came back with 105 and which side came back with 155. Gabriel? And why? You work for the buyer, right? But if you look at the valuation standing alone, 200 pages, the equity risk premiums, betas, cash flows, cost of capital, all the kabuki dance stuff, right? Which is, look at me, I'm doing discounted cash flow valuation. But this could have been foretold. You work for the buyer, you came in with a low number. You work for the seller, you came in with a high number. The difference was so large, they decided to call in a third investment banker. Why? Why settle for 2 fees instead of when you can have 3, I guess? And you guys are going to be Wasserstein Perella. I'm going to say something incredibly harsh about these guys, but I mean every word of it. These guys couldn't value a $20 bill in a brown paper bag if you put in front of them. They'd invent some multiple, enterprise value to cash in the bag. Next thing you know, you'd be paying $66 for a $20 bill. But if you're Wasserstein Perella, you're caught in the middle, right? You don't want to piss off either side. 105, 155, where's the safest place for you to be? Right on the middle, 130. They came back with $127 and I think 52 cents. I'm going to let you in a little secret in valuation. If you're ever asked to value something, never ever come back with a nice round number. Don't tell me the target price is 40. Tell me it's $38.87. It's amazing what that second decimal point will do in terms of intimidating people who might have thought of asking you questions. So I'm not asking this guy. It's got the second decimal point nailed down. Right? One of the great tragedies in valuation is most valuation, tragedy is probably too strong a word, but the reality of valuation, most valuations, the value gets set first, the valuation follows. It's not supposed to be the way it is, but it is what it is. Bias. What can you do about bias? Absolutely nothing other than be honest at least with yourself. You don't have to be honest with your clients, at least be honest with yourself. Right? In fact, no, I would suggest you write your priors out right after you pick a company. You know what I mean by writing your priors out? So I've picked a company. I think I'm going to find it undervalued because I really write it out, put it in, because that's a way you kind of remind yourself you're walking in with these biases. In fact, in statistics, there's a branch of statistics called Bayesian statistics. Have you heard of Bayesian statistics? So in Bayesian statistics, what do we do, Samina? Can you describe what you do in Bayesian statistics? Let's say you're doing research on a vaccine, right? And you're trying to see if the vaccine works. In Bayesian statistics, before you show me your research or even do your research, you're supposed to tell me, before I even look at this vaccine, my belief is this vaccine will work. Because we all start with some priors, right? That's called a prior. And then you show me what you found. And let's say you find that vaccines do work. Doesn't mean I'm going to throw your research out, but I'm going to discount it because your priors and what's called your posteriors match up. But let's say you go and say, I don't think this vaccine will work. And you're being honest about your priors and you find the vaccine works. That research is, think of how much stuff passes by as research findings that you read about in the news. And then you ask yourself, can I trust this research? And part of the reason you feel wary is you know that people bring in agendas and biases into this process. I've done enough research. There's a reason I don't do academic research anymore. It's pointless. because the end game is often, people, academics claim we were objective. No, there's no such thing as objective. If you have a strong enough preconception, it's going to find its way. Second stop. If I do good valuation, I'm going to get the right answer. Leon, when does that get started? When does that feeling of, if I do things right, I get the right answer, when does that? You start in first grade, like all of us, right? First grade, teacher comes up, puts a sheet of paper in front of you, 3 + 2, you get 5. Congratulations, you got the right answer. You get any other answer, what are you told? You got the wrong answer, start on your fingers again, right? Just get the answer. If you got the wrong answer, you must have done something wrong. That gets drummed into you over and over. And God help you if you go on to maybe, how many of you are recovering engineers? Then you get 5 more years. If you do the right, if you do things right, you get the right answer. If you got the wrong answer, you must have done something wrong. And then you end up in this class and you bring that same lesson with you. You say, if I do things right, I'll get the right valuation. If I get the wrong valuation, I must have done something wrong. This is a recipe for beating yourself up. Because you're going to be wrong, not because you didn't do the right stuff or get the inputs right. It's because there's a whole world out there that's not in your control. So if you valued NVIDIA last Friday, it's unfair of me to come in and say, how come you didn't see this DeepSeek thing coming? The truth is there are no right answers. The problem with fair value accounting is they think the end game in valuation is precision. That's why they write all these rules. Their description of a good valuation process gives you the same answer over and over again. So 100 people try it. And the word they should be really focusing on is accuracy. Can you be accurate and imprecise? Absolutely. If you're valuing a young company, accuracy basically means you're trying to get close to the right answer. Precise means you get the same wrong answer over and over again. How is that a great practice? So the truth is, when you value a company, your answers are going to be imprecise, inaccurate, and it's not your fault. But what if you have 2 companies with wildly different characteristics? Let's go back to March of 2019. I was teaching this class down in Paulson, and it was a wild week for IPOs, a lot of IPOs coming out. And that week, 2 companies went public, high-profile companies. The first was a company called Lyft. Lyft actually predated Uber. It was the first ride-sharing company in the world to go public. So you guys are going to value Lyft. The other company later in the week that went public is a company called Levi Strauss. You think Levi Strauss didn't go public till 2019? They've been around 150 years. They used to be public in the last century, were taken private, and they were going back public. So you guys are going to value Levi Strauss. So I'm going to ask you a very easy question, I think. Which of these 2 companies do you think I can value more accurately? And what is it about Levi Strauss that makes it easy to value? They have a long history. You know exactly how they make money. If you're confused and you're wearing jeans, just turn and look at the back of your jeans in a mirror. There it is, like the 501 is still carrying the company. And what is it that makes Lyft difficult to value? These guys can't figure out how to make money. They know how to scale up. None of them. It's a business without a business model. So how did it get so big? Blame VCs who kept feeding capital, saying, don't worry about business models, just have more riders, more cities. They took it to heart. Much more difficult to value because the history is tumultuous, to put it mildly. You have no idea whether the company can ever figure it out. And if I judge valuations based on which one is more accurate, Levi Strauss will always get an A and Lyft will always get a C. And if I did that, guess what everybody's going to value? Kraft Heinz and Levi Strauss over and over again. But that doesn't make sense. And here's why. It's true Levi Strauss is easier to value than Lyft. But I'm going to ask you a follow-up question. Where is the payoff to doing valuation greater? What's the payoff to doing valuation? You find a market mistake, right? Where do you think the payoff to doing valuation is greater? Levi Strauss is easy to value, but it's easy to value for everybody. In fact, I don't even think you need a body, right? You could probably get ChatGPT, please value Levi Strauss. My guess is the answer will be pretty close to what you got because ChatGPT can be trained, look at history, do the extrapolation. Conversely, most people will not even try to value left because they give up, too much uncertainty. You know how often when I talk to VCs, they give me that answer because most VCs have never, ever, ever valued a company. They price companies, hundreds of them. They price it on subscribers, users, all kinds of neat stuff. But they can't, and you ask them, why don't you value companies? Their answer is there's too much uncertainty. If any of you haven't picked a company and you're saying, what should I pick? Go where it's darkest. Sounds like an ominous threat. Find a nice Ukrainian mining company to value. Good luck with finding a nice Ukrainian mining company, but you'll never again complain about risk and uncertainty after you value the Ukrainian mining company, right? Because that's where market mistakes are greatest. If you've never owned NVIDIA, this is the time to value NVIDIA. See, let things settle down and no, this is it. This is when uncertainty is greatest. This is the time to target companies. Bias, uncertainty. And the third component here is complexity. Yes, I don't see a nameplate. What's your name?
Sorry, I lost my name, that one. So when you look at situations that are uncertain, and let's say it's not hugely uncertain, right? There are maybe 15 plausible scenarios that could play.
No, let's face it, the world lives in continuous space. The scenario thing already is going to get you into trouble, right? So we do that for convenience. Scenarios work better with regulatory or risk. But let's suppose the world is simple and so the number of scenarios tells me how much uncertainty you face, or the differences between the scenarios.
Just in any typical situation like this, does it make sense to look at like the expected value of?
It's always the end game, right? The question is, how do you come up with expectations? You build them as an expected cash flow, or do you let's say you do 15 scenarios, you come up with 15 values. To make this into an expected value, what's the last piece of the puzzle?
Probably.
In theory, that's what we're supposed to be doing in valuation. In practice, we very quickly realize that that's not going to get it. First, in most companies, there are no 15 scenarios, right? I'll give an example of a case where I did use scenarios. When I valued EasyJet in 2019. Why did I use scenarios? Because it was facing this moment where you didn't know where Brexit would go, right? You know, it could fall apart, good Brexit, easy Brexit. So I actually valued it 3 times because it is a very different end game. Reserve scenarios for times when you're looking at regulatory changes that can make a company more or less valuable. But we'll talk about other tools, better tools for dealing with uncertainty. This brings me to the third misconception about valuation. If I make my model bigger, it's going to get better. Most deadly trap to fall into. I'm going to give away my age, and so, you know, since you can look it up in Wikipedia, you can. It's not. I'm not giving away some state secret. By telling you what I used on my first valuation, 1981, I picked a company to value. I don't even remember the name of the company, but you know what I had to do to get the annual reports? I had to write to the company with a fountain pen. Write to the investment relations, could you please send me an annual report? I sent it by mail, snail mail. 2 weeks later, to give the company credit, by snail mail, I get an annual report in the mail. I'm deliriously joyful. I open up the annual report, and here are the things I had in front of me. I had a ledger sheet. You know what a ledger sheet looks like? Just a blank sheet of paper with lines already pre-drawn. Huge innovation from my perspective, because I always got the lines crooked. So I had the columns, the lines all drawn. I had nothing on the sheet. I had a calculator, not a slide rule. I'm not that old, but not a calculator on the side. And a pencil. I learned very early in my valuation life, do not write things that you can't erase, because you will have to erase things. And I start filling out the valuation. When you do a valuation with a ledger sheet, a pencil, and a calculator, how many line items do you think there will be in your valuation? As few as you can get away with, right? Because every single cell has to be hand calculated. You add an extra line item, that's 10 more cells. You're calculating each one. Valuations were parsimonious because you had no choice. I told you I'm planning to revisit my NVIDIA valuation this week. You know where I'm going to go? I'm going to go to Capital IQ. I'm going to send you the specifics of how you can get it. It's an amazing database. In about 1 minute, I can download every single financial data item in NVIDIA going back through its entire life. 26 years, I can download. Take 1 minute out of an entire spreadsheet. While I'm there in an extra 2 minutes, I can download the financials for every semiconductor company in the world. In 3 minutes, I have all this data. I no longer use a ledger sheet, a pencil, and a calculator. I have an Excel spreadsheet and some things pre-built into it, so I can put the numbers in a spreadsheet. And if I want to add a line item in a spreadsheet, sometimes it's so smart, I don't even have to copy and paste. I do it, it remembers the equation of the previous one, it fills it out. It's amazing, right? Say, that took a little less. Well, let me add another line item. And you can see where this ends up, right? At the end, you end up with what I call banking valuations. Have you ever seen banking valuations? Usually there'll be 10 worksheets, 500 line items, all connected in some mysterious way. By whom? You have no idea. It was built by somebody somewhere. You have to call IT when something goes wrong with your reinvestment. You're completely. It's easy to build complex models. And people say, well, I'm doing it because I want my models to be more realistic. But remember, you want your models to work better at getting value. Two things happen with these models. One is they become black boxes. You feed numbers in something. You know how you can tell is when an analyst writes a valuation report, and in the valuation report, they say the model valued the company at. Really? What did you do? Sneak into your office in the middle of the night, value the company, leave it on your desk? But the analyst is saying, don't blame me. There's this complex model, and I feed numbers in. I work for the model, not the other way around. Get black boxes. The second is what I call input fatigue. You know what that is? Usually hits you at Saturday night at 11 o'clock. You're still at your desk at an investment bank. You've been working all week. And your managing director comes, throws an annual report on your desk, a physical report. Say, I want this company valued first thing tomorrow morning. It's his trial by fire. He wants to see how much you really want this job. You think briefly about your option to abandon. Very satisfying when you exercise it. Usually takes the form of picking up the annual report, throwing in your managing director. You do it yourself. That's a deeply satisfying moment as it leaves. But then deeply dissatisfying things follow, including how the heck are you going to pay your rent? So you think briefly about that moment, and then you say, okay, I'll value the company. And with the in-house valuation model, and you start entering numbers, hundreds and hundreds of inputs. You get to the 75th input. It says, what was the working capital 5 years ago? Part of you wants to get out of the chair, go look it up, but it's too tired. The other part says, just make up a number. Just make up a random number. It's amazing how the random numbers roll out. And the scary thing is when the output comes out, it's so complex that the random numbers swim with the numbers you spent hours thinking about and nobody has any idea. Complexity is something that technology and data allowed, and we've fallen into the trap. In fact, I'll send you a link to a session that I did called the Bermuda Triangle of Valuation. Because somebody asked me, can you come in and talk about valuation, how to do it right? They thought I was going to come in and talk about betas and cost of capital and how to get cash flows right. That's not why valuations fall apart. It's because of the three things we talked about: bias, complexity, and uncertainty. The reason I use the word Bermuda Triangle is there's a mythical area in the Atlantic where supposedly ships and planes go to disappear. The Bermuda Triangle is where good sense disappears. Okay. You're going to be fighting those battles as you value companies. Okay. So it's better to be open about that bias and complexity, uncertainty, and make your own compromises. Okay. So I'm going to set the table for what this class is about. There are three ways you can put a number on a company. The first is intrinsic valuation. What is intrinsic valuation? You value an asset, a company, a business based on its cash flows, growth, and risk. Now you can dress it up with a discounted cash flow valuation, but intrinsic valuation predates discounted cash flow valuation. Discounted cash flow valuation, as we know, it is about perhaps 85 years old. I think the very first mention was a 1937 book by John Williams. But that Venetian glassmaker in the 15th century sold his business based on cash flows, growth, and risk. Trust me, that's what people have always did. So we're going to start with intrinsic valuation. Then we're going to move on to another way you can attach a number to a company, which is you price it. And we talked about this in terms of the theme. What's different is demand and supply. What do other people pay? So we're going to do, that's the second. There is a third subset where there are some assets whose cash flows are contingent, or some businesses where the cash flows are contingent on something happening. Again, I briefly mentioned this, I think, in the first class, but if you're a young pharma company with a drug working its way through the pipeline, there is a contingency. If it gets approved, you could be a $1 billion company. If not, you're worth nothing. That's the special place where real options inhabit. We'll come and talk about real options and how. It's a very limited space, so don't get crazy about applying real options everywhere. But there are only 3 ways you can put a number. I want to already dispel this mythology that there are hundreds of ways you can value companies. There are only 3. Within each, you can make choices. But are you doing an intrinsic valuation of pricing, or are you talking about a real option? So we're going to start this class off and spend a big chunk of it talking about intrinsic valuation. But before I go there, during my office hours, and I do have office hours, drop by when you get a chance. Somebody from my undergraduate valuation class came in and said, "Do you think markets are perfect?" I said, "Can we rephrase that a little bit? Perfect is such a strong word." I said, do you think markets, your watch will talk to my watch. So I completely, because I got tired of it talking back to me. I was working this morning. It said, stand up. I said, what? He says, you've been sitting too long. I said, how would you know? Okay? Maybe I'm doing exercises while I'm sitting down. So, but no, I said, do you mean, is the question, are markets efficient? She said, yeah, that's the question I'm asking. I said, if I believe markets are efficient, would I be teaching this class? Because in an efficient market, what's the value of NVIDIA right now? The market price is the best estimate of value. Not a bad assumption, right? But the minute you open up the process, now I'm going to value companies, I'm going to price them, whether you like it or not, you're implicitly telling me that markets make mistakes, that you can find the mistakes with your pricing metric, PE ratio, price to book, or with your discounted cash flow models. And is there something else you're also telling me? To finish the story, is finding a market mistake going to make you money? No, not unless the market, Scarlett, corrects its mistakes. Don't forget that last piece. You can find a market mistake and go bankrupt. What's your saying? The market can stay irrational longer than you can stay solvent, right? It's a good thing to remember, right? You think you're right, you're rational, the market can do crazy stuff. So I'm going to argue that these 3 approaches make different assumptions about market mistakes. And as you think about these 3 approaches, what I also want you to think about as an end game from this class is, which one do I want to put my trust in as an investor? I'm not going to pre-sell you and say you have to do intrinsic valuation. You have to make your choices. And one of the things that are going to drive those choices is, what kind of mistakes do you think markets make? So let's start with discounted cash flow valuation. What is it? It's the very first class we all get in finance, right? Foundations class probably started with this, which is the value of an asset is the present value of the expected cash flows. In the old days, we used to make you buy a financial calculator. You know why? To teach you the meaning of a sunk cost. Because you then came to a first finance class and you didn't like it and you wanted to drop it. Now you can, but there's a sunk cost. The bookstore won't take your calculator back. But you used to wear out that button on your financial calculator, the PV button. There were all these virgin buttons you never touch. Have you noticed in your calculator, E2, XL? What the heck is all of that stuff? You don't touch the PV button. Because 80% of finance is a present value problem. Intrinsic valuation is an extension of that very, very core basic concept. Philosophically, what are you trying to do? You're trying to estimate the intrinsic value of something. And I have some bad news. You'll never get to see it. It's like a little bit like the search for the Holy Grail. How long have people been searching? 1,000 years, 1,200 years? Has anybody found it? I think Indiana Jones in the first movie came really close, but even he didn't get it. Intrinsic valuation is very much like the search for the Holy Grail. You keep looking and you keep looking and you never find it, but you keep the faith. And if you break down discounted cash flow models down, no matter how complicated they are, here's what you'll see. You see a life for the asset, expected cash flows over that life, and a discount rate that reflects the riskiness of the cash flows. Are you assuming you make markets make mistakes when you do discount? Absolutely. You're also assuming you can find those mistakes with your DCFs. And then you're also assuming that the market will correct mistakes with the DCF. You're saying, how do I make that happen? You could go on social media and post NVIDIA is undervalued, NVIDIA is undervalued, NVIDIA is undervalued. Maybe you have millions of followers. Maybe you can get Mr. Beast to post for you. I always what 100. What is he? 100 million followers on YouTube. Maybe you can do a YouTube video. NVIDIA is undervalued. But the reality is, most of us don't control the process. See, how do I ensure corrections happen? You don't. That's why I use the word faith. I do have two pieces of good news. One is the longer your time horizon, the greater the chance, assuming you were right in the first place, that the price will adjust to value. Already I've given you one of the things that should determine whether you should believe in intrinsic valuation or pricing. Ask portfolio managers what the typical time horizon is. They say long term. You know why? Because that's what you're supposed to say. So ask them a different question. How often do your clients come and bug you about what the portfolio is? And every 3 months, it's okay, that's your time horizon. They say, should I do intrinsic valuations? They don't waste your time, do pricing. Not because you can't get value right, but in 3 months, who knows what the market will do? The longer your time horizon, the greater the chance market will correct its mistakes. So let's think about the advantages of discounted cash flow valuation or intrinsic valuation, the disadvantages, and who might be the best kinds of people to use intrinsic valuation. Because intrinsic valuation requires that you estimate cash flows and growth, it requires that you understand the business. You cannot value Cisco if you think it makes vegetable oil, right? Because you can know everything about cash flows, growth, and risk. You cannot value NVIDIA if you can't at least get a sense of this AI market and where it's going. It requires you to understand the business, the company, the management, and that's a lot of work, right? And it exposes you. Why? Because you make an assumption. What percent of the time are you going to be wrong? 100%, and people are going to pick on you. I got your cost. You have to get used to that. That's okay. But it is in line with, people who claim to be Buffett followers. One of the things that he said that I truly buy into is he said, I don't buy shares in a company, I buy a piece of a business. And if that's your ethos, then you should be using intrinsic valuation. So those are the advantages. You think, what are the disadvantages? It's going to require a lot more work. I can price a company in 3 minutes because I really don't even need to know what you do. I find other companies like it, look at what investors are doing, attach a multiple, I'm done. Discounted cash flow valuation does take time and more inputs. I'm going to later on redo pricing. I'm going to argue that embedded in pricing are assumptions about cash flows, growth, and risk, but you don't have to make them explicit, which means you can never be critiqued for getting them wrong. And when you do an intrinsic valuation, you can find a company to be undervalued or overvalued. But let's say you're an equity research analyst, you decide to do discounted cash flow valuation. You value the 15 companies in your sector. Is it possible that all 15 could come out as overvalued? It can happen. Then what should you do? Put out sell recommendation all 15. You know how long you last as an equity research analyst if you did that? You're going to be fired. Your job might require you to have a balance. You're an equity portfolio manager at Fidelity. Can you imagine going up to your boss and saying, you know what, I think all stocks are overvalued. I'm going to pull all the money in the fund out and hold it in cash. You should be fired because that's not your job. Your job is to be fully invested in equities. The problem with discounted cash flow valuation is it doesn't lend itself to that nuance. So let's think about the kinds of people for whom intrinsic valuation works the best. First, philosophically, you got to think about businesses. Investing in businesses, not buying shares. Right? Second, if you think about where this can be applied, it can be applied only on investments that generate cash flows. So if you ask me what the value of something is that doesn't generate cash flows, I'm going to tell you it can't be valued. You're going to be deeply disappointed in me, but I'm just reflecting the truth. So what's an investment you see out there, always in the news, that people keep asking, is it undervalued or overvalued, where you could use this? Bitcoin, right? 100,000. You know how many times I keep getting asked, is Bitcoin undervalued? You can't value Bitcoin, not because it's crypto, but because it's a currency. So ask me, can you value the dollar? I can price the dollar against other currencies. It's called an exchange rate. The Bitcoin price against the dollar is an exchange rate. I can price it. I can't value. Can you value Picasso? Of course not. I can price it. It's a collectible against other Picassos. So stay in your lane with intrinsic valuation. You can use it. And for the kinds of investors you think about, first, it's nice to have a long time horizon. But remember, you don't often control it if you're managing other people's money. So if you're a portfolio manager, I start an advantage over a portfolio manager because a portfolio manager has a client to answer to. But if you're managing your own money, you control your time horizon. The only person I have to answer to is my spouse. And I've turned off the statement, so it's paperless now. At any given point, she has no idea we've invested in NVIDIA. So she hasn't asked me any questions this week yet. But I'm willing to hold as long as I need to. So do you have a long time horizon? You know, later on in this class, we're going to talk about the most famous value investor of all time. Who we're talking? Warren Buffett. And what he brought to the table that allowed it. I mean, he didn't use private information. He wasn't using insider information. So what was his biggest edge in this investing game? What do you think he brought to the table that other investors could? Other? Sorry about this. A telemarketer trying to sell me something. Go ahead. But why does he have a long time horizon? Why doesn't he have clients who come back and bug him just like portfolio managers do? What money is he investing? Let's face it, Berkshire Hathaway is a really good insurance company in Geico with a closed-end mutual fund. Every insurance company is like that, but most insurance companies, a closed-end mutual fund is not a value creator. It's run by an average investor if you're lucky, or a below average one if you're not. Berkshire Hathaway is an insurance company with a closed-end fund run by the most famous value investor of all time. And when you invest insurance company capital, what drives your time horizon? It's the actuarial tables, right? And the good thing about actuarial tables is they don't panic on you. In 2008, in November of 2008, and remember, in 1 week, in that first week of November, Warren Buffett took positions in Bank of America and Goldman Sachs. Okay. This was in the midst of one of the worst financial crises of all time, and financial service companies were right at the heart of it. And there are a lot of portfolio managers said, look, I think Goldman Sachs will make it through. It's going to be one of the survivors here, But they couldn't take a position because they couldn't go to their clients and say, I just bought Goldman Sachs. I'd have been fired on. But Warren Buffett said, look, I'm investing actuarial money. I'll take it. The biggest advantage you can have as an investor is to be able to sell liquidity, which is a nice way of saying, I have a long time horizon in the midst of a crisis. I can buy things. Long time horizon is nice. Would it be nice if you could also be a catalyst to make that correction happen? You know what I mean by that? You buy something undervalued. Remind me again how Carl Icahn runs his fund. I'm not talking about the Hindenburg view of Carl Icahn, but the pre-Hindenburg view. What does he do? He takes a position in a company, right? Then does he stay really quiet? No, he gets as loud as he can. You see him everywhere. And what's he saying? The stock is undervalued, but it's Carl Icahn, so other people join in. The one things that activist investors like Bill Ackman and Carl Icahn and Elliott have going for them is they can act as their own catalyst, which is they can trigger that correction, which makes the process a little more controllable. And finally, and this is, I think, the psychological issue. Let's face it, in intrinsic valuation, you're often going to be going against the crowd. Everybody around you is going to tell you you're crazy. And if when you were in school, you were easily swayed by peer groups, you will not be a good candidate for intrinsic valuation. But if in school you were that obnoxious kid who did the opposite of what everybody else was doing, this is your chance to revel in that bad quality. The nature of intrinsic valuation is you're more likely to be a contrarian, buying things when other people are selling. You're saying, in theory, I'm a contrarian. In practice, it's really difficult to be a contrarian. Because that would have meant buying NVIDIA on Monday morning. And think about how much that requires you to go against what everybody else is doing. So we'll pause there. When we get back on Wednesday, we're going to talk about pricing and real options very quickly. And we're going to start in the first packet. So if you haven't downloaded the first packet, please do so. It's a really big packet, so it'll take a while to download. Have some patience.
I just feel like it's like.